We're in the business of telling you how to grow your wealth. It's even in the name, NDTV Profit. And we often talk about powerful concepts like staying the course and compounding that are part of the recipe for success. But there are things that people don't tell you about creating wealth, and that's what I'd like to talk about on this episode of Money Wise. My guest today is Vijai Mantri, someone I've always appreciated for being a straight shooter. Vijay, thanks so much for taking the time.
My pleasure.
Now, I want to talk about this because a lot of people have said that it's important to start early. And this is something that we tell everybody that we meet. Start early, but people worry about when they should start in terms of where the market's at. And some people, rightly so, have pointed out that in some pockets, valuations are stretched. But does it really matter when you start?
See, in a way, yes and no. The answer is both. But the point is that the markets and market tops and bottoms are only known after they actually happen. So while when you take a decision at that moment, nobody knows whether the market is topping or not. We are hearing the same narrative for last almost 18 months. The market is topping, valuation has stretched. But what happened? The mid-cap index is up 50%, small cap 60%, Nifty 30%, Nifty 500 around 40%. So you almost lost 2 to 3 years money listening to people like us. So actually so the best thing to do is to, when you have money, start investing and expect 10 to 20% volatility on your portfolio at whatever level you start, whether you start at 26,000 Nifty or 20,000 Nifty or 15,000 Nifty. So before you look at the return, you should look at what is a drawdown possible on your portfolio and how comfortable you are with the drawdown. Serious wealth cannot be created without going through the journey of drawdown. If you're just looking at 20% return and say 20% nahi mila to 18 mil jayega, 12 mil jayega, but the journey doesn't happen like this. The 20% return can become negative also. And particularly when you start, then the market can go down 10%, 20%.
What's the worst loss that you've incurred personally? And what is the learning that you had from that?
The worst loss I incurred was 58% drawdown in 2008. And I knew this will happen, 20%, 30%, but 58% in 2008, nobody expected, but it happened. But the good thing is I didn't take money out. So what happened that when the market recovered, my portfolio also went up. But I do remember people in 2008, they took money out in November 2007 or December 2007 or January 2008, almost at the peak of the market. But these guys were not able to re-enter. So my portfolio, which has witnessed 58% drawdown after 4-5 years or 6 years, was doing very well. And the guys who were trying to time the market actually got one leg of the timing right, but they could not re-enter. And we have seen that playing out again and again.
And that really is the key, right? Because if you are trying to time the market, you have to be right on 2 occasions, which is very, very hard to do.
Impossible, absolutely impossible. And just look at one of the greatest investors, Warren Buffett, sitting on cash for last 2 years.
And a significant amount of cash.
Significant amount of cash. And we have seen even in India, certain portfolio manager who are sitting on 30% cash. Now the problem when you sit on 30% cash, you're always figuring out that 30% cash call should be right and not worrying about 70%, which is an equity. So you always pray the market should go down. So it is a very, very, in my mind, confused kind of status people would have. Money invested in the market and the market going down have a cure. Money not invested in market have no cure.
What is the cure for money invested in the market that is going down?
So you keep investing, regular investing is one of the best way to participate. Suppose, let's assume that you started at January 2008 when Sensex was 21,000. And suppose you started on that day only, okay? And the market went down to below 8,000 by March 2009.
Yeah.
So your portfolio is effectively down 50% plus, but your SIP portfolio is down only 35, 36%. But by June 2009, the market is only at 15,000. Starting point 21,000, market went down to 8, 9,000, came back to 15,000. From 21,000, 15,000 is still 20, 30% lower. But since you are investing at every level, at 15,000, you are in money.
You're in the money.
Yeah.
And that's a powerful concept. Nobody's saying that this exact scenario will play out again, because incidentally, the next crack that took place, the next major crack that took place was a 38% drawdown in the Nifty 50
COVID.
when COVID happened. But
yeah.
the crash happened over 2 months or 2.5 months,
Yes.
as opposed to 14 months of the 2008 financial crisis.
So in 2008, the market came back to the same level after 73 months. In 2004, 2019-92 it came after 136 months, and in year 2000 it came after 54 months. So, but the point is that when we give this number of 72 month or 134 month, we assume that people invested only at that particular moment and exited at the bottom. But nobody invests only at that particular moment.
Yeah.
So if I pick one of the longest bear phase in the market was from 1992 to 2003-4, almost 11-year no money, provided you started at the top and exited at the bottom. But let's assume you invested 6 months before, continued to invest, and even invested 6 months after. The loss come down substantially. And suppose you started 12 months before and continue your journey after 12 months, you are in money in 18 months time.
Okay.
Instead of 11 years. So that is a power of investing on a regular basis, because nobody knows the tops and the bottoms of the markets, are they're only known when they happen.
This was actually proven in a report that studied various market cycles over multiple periods. I believe it was White Oak Capital.
Yeah.
And they said that you start an SIP at the peak, you start an SIP at the bottom, obviously the bottom being after the peak. And they found that the difference between the two was barely anything, if at all less than a percentage point over the course of 14 years or thereabouts.
So that's very true. And very interestingly, people say we made money. Gold is considered to be the safest investment option, real estate, and people say we made a lot of money. Interestingly, people made money in gold and real estate not because of view, but because of holding period.
Yeah.
Your holding period was forever. Gold in India from 1946 to 1966 for 20-year period, and INR has not delivered return. Even recent past, 2011, 2018, gold has not delivered return. So we have 10, 10, 7...
Sorry, say that again?
2011 to 2018...
Because of the depreciation of the
whatever
rupee.
the reason.
Okay.
In INR, I have seen 5 years, 7 years, 10 year, 20-year period where gold has not delivered return. But people never complain.
But despite the fact that it is globally one of the top asset classes over the last 14 years.
Exactly, but in spite of that, and only, it's not a global big asset except for Indians.
Yeah.
It is not, not a big asset category. It is, so large part of gold is owned by Indian and Chinese.
Yeah.
So when you look at gold, the way people own gold is very, very interesting and very instructive, the way people own real estate and the way people own equity. So when you own gold, and if you ask anybody, आपका gold कैसा है? So nobody will tell you CAGR. बोला मैंने 17 में लिया है, 2 किलो सोना है, 3 किलो. Nobody talks about CAGR. Nobody talk about drawdown.
Yeah.
So it's very interesting on the day on which, on the day of budget, the government has reduced duty on gold, and the gold prices went down by 4,000 to 6,000 rupees per 10 gram. And everybody is saying, "Kharidna chahiye kya?" Now assume on that day, suppose Nifty has to go down 4%. There's no faith in equity market where perhaps the wealth creation has been the longest, the best. And when I talk to people, say, real estate और gold में तो क्या हमको दिखता है जी, equity में दिखता नहीं है, तो हमारा डीमेट स्टेटमेंट, अकाउंट स्टेटमेंट है. तो मेरा सिंपल सवाल होता है कि आप बॉम्बे में रहते हो, रेसिडेंशियल प्रॉपर्टी है आपकी, क्या प्रूफ है आपके पास? सोसाइटी का शेयर सर्टिफिकेट है. यू एंड मी आर इंडियन सिटीजन. व्हाट इज द प्रूफ?
Passport.
पेपर ही होता है ना.
That's true. Okay, that's a fair point. And a very interesting point that you've made. So therefore, okay, in your opinion, and this is, I can anticipate what your answer is going to be. Long-term wealth creation, is equity the primary tool?
Absolutely, because what is the biggest risk to your capital? The biggest risk to your capital, suppose you have 500 rupees not in your pocket, and if I have to ask you, protect this. So you take 500 rupees and put in a locker. After 10 years, what happened to that 500 rupees? It loses value. So what is the biggest risk? It is not termite.
Yeah.
It is the purchasing power.
Yes.
And what is the concept of purchasing power? The reverse of that is inflation.
Yes.
So what causes inflation? The product which we are consuming their prices goes up. So he
Yes.
gets up in the morning, toothpaste. So toothpaste is too obvious. But when we enter the bathroom, there are many other products we are consuming. We are consuming steel, we are consuming tiles, building material product companies. On average, a typical Indian consume 160 listed companies product knowingly or unknowingly. So their prices are going up. So how do you fight that? You
But-
fight by becoming their owner.
If you can't beat him, join him.
So
right?
I give a very simple illustration. Let's look at the gold.
Yeah.
Who made more money? My great grandfather used to walk to the goalkeeper shop and he had a very small shop. My grandfather used to walk on a cycle and he had a bigger showroom. My father took a scooter and the gold owners opened 2, 3 more showroom. I went in a car and the the jeweler has 7, 8 shops. Who made money? More
jeweler.
money. And one clear instruction, just look at in last 20 years, gold prices went up 16 to 20 times. Or gold has done very great. But Titan has gone up 485 times. Similarly, look at building. You look at building material companies, look at all the wire companies, switches companies, cement companies, steel company, the companies which help you to manufacture or build real estate. Look at the stock price of these companies. Look at Sundaram Finance. Look at HDFC's fund, these kind of things. Sundaram Finance, 20 years, portfolio has gone up. Sundaram Finance market cap in 20 years gone up 100 times. So a choice is between being consumer or an owner. Equity provide you the option to become owner of what you're consuming.
Absolutely. Okay. When it comes to risk, and it's defined differently, some people choose to look at volatility as a measure of risk, not necessarily the best way. Because you've said volatility presents the best opportunity to average your cost if you're holding for the long term. When we're talking about a long-term equity portfolio, in your opinion, is an outperformer on the upside more important, or is the ability to protect your downside more important?
See, when you talk about risk, the perception of risk is very different from the reality of risk.
Okay.
So when we talk about FD, we think it is a very safe investment option. There's a perception. Reality is what? The cost of inflation or the living standard goes up 8, 9% every year and the FD gives you 7%. So is it protecting?
And post-tax.
Post-tax.
It's even
Inflation
lower.
compound, FD rarely compound. When you own real estate, there's a whole kind of risk. When you own gold, there's a different kind of risk, physical threat to life. But the perception that these are safe investment option. When it comes to equity, the perception is that it is a riskier asset because you see the ticker every day.
Yeah.
So you get nervous looking at that number, looking at that thing. You need to understand, in my opinion, volatility is not a risk. Risk is where you can lose your capital permanently. In real estate, you can lose your capital permanently. In a bad debt product, you can lose your capital permanently. In equity mutual fund where you have, or index, where you have 200 or 300 leading businesses are being represented through a different kind of theme, there could be temporary volatility, there could be temporary loss of capital, but there can never be permanent loss of capital unless India is going down. When India goes down, GDP collapse, then forget about equity market, even our businesses will not do well, our real estate portfolio will not do well. So volatility is not risk in my opinion. People should understand and accept. If you want your wealth to grow 20 to 30 times, then you should be able to take 20 to 30% temporary downside on your portfolio.
Sure.
Uske bina wealth nahi banega danka.
Okay, point taken. But when you make investments into equity, you have various choices, right? You can choose to invest in the frontline companies. It's a different style of investing. And I'm talking about building an individual stock portfolio. And similarly, if you're investing in mutual funds as well, or you can choose to invest in smaller companies that have higher potential for growth and that may not be valued as expensively as your frontline companies. The question that I'm asking is that in all probability, the smaller companies have higher risk of drawdown, but higher potential for growth. I'm talking about balancing of risk and return. Sometimes it's not worth it. I see so many people investing in companies that are penny stocks, that don't have functional businesses, but that are trading significantly higher than they were even a couple of years back. And that tells me that people want to make a quick buck. The question that I'm asking is, do you protect your downside or do you go for broke and say 20,000 shares? And I got a question just today on that. 20,000 shares in a company at 47 rupees, which is now 40 rupees. And the gentleman has lost so much money just because they're going for broke in a stock that promised them outsized returns.
So one of the worst thing is that in investment is that how much other people are making. So that is what catches people. And people are not very comfortable growing wealth slowly. So that is a problem. So if you look at what kind of return equity market has delivered 15% compounded. In today's market, if you say 15% return, वो तो मैं एक दिन में बना लेता हूँ. That kind of thing. So when you look at investing in equity, you just need to keep it in mind that what has been the long-term track record. Long-term track record has been 12 to 15%. That is the kind of return you're going to make. If you make excess return, then in future you expect volatility. Either the return will come upfront or volatility will come upfront. So that choice you need to make. So in this market, in the current market, in my opinion, micro cap, small cap, mid cap are in little challenging territory. So advice to investor to avoid taking fresh allocation and do more allocation into large cap or flexi cap and multi cap kind of structure.
Fair point. When we're talking about investing for the long term, a lot of times, and I'm not talking about which product, but a lot of times people say it's important to hit the 1 crore as quickly as possible. And this is from the perspective of building generational wealth. Why is that a very powerful number in today's context, of course?
करोड़पति.
वो तो
कौन बनेगा करोड़पति? So that पहले वो लखपति होता था, but few years back time one newspaper carried a death of a lakh. Now we are talking about crorepati. In some time we'll forget about crorepati. We'll talk about millionaire in USD, 8-9 crore. So yeah, it gives you a sense of you arrived in life kind of your 1 crore of wealth, which very few people in India has. So in numbers it is large, but percentage wise very few people have. So you can do a 10,000 rupees SIP and do for 21 years, you will hit 1 crore target.
at what rate of return?
12% X IRR,
Sure.
so very normal. So 10,000 rupees SIP, 12% X IRR in 21
Without
years.
stepping it up.
Without stepping up. But if you want to go faster, then you do 10,000 rupees and every year increase your SIP amount by 10%. Instead of 21 years, you will come that number will come to 16 years. But keep in mind, 1 crore today, 20 year down the line,
Is not going to be 1
is
crore.
not going to be 1 crore. So if you are keeping target of 1 crore, looking at current market condition, you should look at current, where we are. I think you should look at $500,000 as a target, not 1 crore. Because today's 1 crore will be $500,000 USD, 4 crore 21 years later. So I think you need to increase your SIP allocation from 10,000 to 30,000-40,000.
Do you think that this is one of the most common mistake that people make when they look at their finances? A lot of people get swayed by these numbers. Of course, we're living in Mumbai where property prices have gone absolutely berserk, and you have, 2 BHKs that are selling in the suburbs that are, 2 crores, 2.5, 3 crores. It's unimaginable for large parts of the population. But then outside of Mumbai, if people say, look, I want to retire with 3 crore, it's not something that is completely unprecedented. But are they truly valuing what that 3 crore is going to be 20 years down the line?
I don't think, because what is happening that, forget about the inflation, which is like 6%, 4.5%. The real inflation is much higher because of discretionary spending, healthcare, education. These are hitting 8 to 9% numbers. So the 3 crore will not remain 3 crore. So don't take that number as sacrosanct. So lots of people want to retire early. My advice to them, don't do it. It is not right. Other way as well, forget about financially as well. So keep working as long as you want to work, and keep saving, build a corpus, and then when you have you just look at one thing, whatever corpus you have, and if you just take 4% of that corpus every year and increase it by 6 to 8% per annum, and that is enough to fund you for next 20 years, that is a magical number. So let me make it very simple. Suppose you have 1 crore rupees as your corpus. You should be able to take 4 lakh out every year and then increase it by 6%.
The amount that you would draw.
Yeah. So you need to figure out is 4 lakh is enough for you to run your household. Whatever that number is, you take 25 times of that. I think that is the right number. So
25 times of your annual expenses.
Expenses. And we haven't considered tax in that.
Wow. Okay. So, but I'm pretty sure that most people, even people listening into this, they're not going to be at 25 times their expenses.
No,
They
they are
may
not.
never reach 25 times of their
Absolutely.
expenses.
Yeah. So that is a big worry, very honestly. That is
Okay.
a big worry, but the only part is that the family size is becoming shorter, the wealth accretion is happening, people have legacy wealth, they will inherit something, they have a real estate portfolio, they have inherited gold, so just not financial assets. So
Yeah.
I don't see that kind of distress with many, for instance, look at 20 years back, we were saying Europe will go through pension crisis.
Yeah.
It didn't happen.
It hasn't happened yet.
You know, it won't.
You think it won't?
No, no.
Okay, but that's a conversation for another date.
Yeah.
I'm curious what you think about gambling, Vijay. What's your opinion on gambling?
So it is the charm of outsized gain is always there. So I put 1 rupees and I get 1,000 rupees. That charm will always be there. It is too human not to gamble. So it is as old as hills. People will keep gambling. So if you are a smart investor, you make money out of the stupidity of people. So for instance, we have seen SEBI data which says in last 3 years, retail investor in F&O lost 1,80,000 crore rupees. Who made money? Stock exchanges, custodian, brokers.
You were talking about the jeweler.
So exactly. So BFSI. So you don't, if you see, people have unhealthy habits, people are consuming more alcohol, then, pharmaceutical companies will do well. So आप कर क्या सकते हो? आप किसी को समझा नहीं सकते. People won't listen. People are too addicted to habits. So they won't. So speculation is not even, F&O is not even a speculation. It is actually addiction.
It is. Interestingly, the original concept of F&O, it's supposed to serve as a hedge for what happens in your portfolio, but nobody uses it like that, Vijay.
Actually, very interesting. The oldest addiction humanity has is of salt. Your starting point is always good. It's preserve food, it make food tastier, but the way we live has changed. We stop sweating, but we consume the same quantity of salt. So what happened? It leads to high blood pressure. So everything start with a good intent and they had a good utility, but we don't, first we overuse, then we misuse, then we abuse.
Yeah. Okay. So, in case it wasn't evident, by gambling, I was talking about trading derivatives, which a lot has been said in the recent past. So I'm not going to say anything more. But I do want to talk about when you should sell. And I know that we're talking about building intergenerational wealth, and the idea is that you don't sell the family silver. But ultimately, there are moments where certain holdings might require you to sell. You mentioned it yourself. You don't want to delve too much into the broader end of the market right now, to micro cap, into small cap. In some instances, the valuations have skyrocketed. Do you use these opportunities to take money off the table at all, or do you not worry about that?
So if you do that, then don't regret if they go up after you're selling it. So the question is that why not the same question when it comes to gold?
Or real estate.
Real estate or FD. Why it comes to, or insurance? Why it only in equities? Why not NPS? Why not EPF? Or why equity where allocation is only 5% of total household wealth?
Sure.
But let's take the way it is. Okay. So when you should sell? So one is that when you need money, don't bother, very honestly, sell. Use the money for whatever purpose you want to upgrade your car or house or whatever reason you do that, kids education, that is the way to do it. Second thing is that when the equity has grown out of proportion as far as asset allocation is concerned.
What is the definition of that, though?
So I'll come to that. A lot of people say 100 minus your age should be, I don't believe in that logic, because everybody have a different kind of thing.
Yeah.
So I have a very simple way where I address to my investor. Number one is that you figure out what would be your total expenses over the next 3 to 5 years. Your household expenses, your EMI, car loan, whatever is, and how predictable is your income is going to be. The gap has to be always in debt and debt-oriented product. Beyond that, money start moving into hybrid, balance advantage fund, and then go into equity mutual fund. But keep in mind, even suppose you have 1 crore rupees and 20 lakh invested in debt product and 80 lakh invested in other product. But on that 80 lakh rupees, you should be mentally prepared that portfolio can go down 20 to 30% any point of time. Now, you should take equity exposure to only to that extent where you are comfortable with 20 to 30% going down. So instead of 80 lakh, you say, no, I'm not comfortable on that, so I'll invest only 50 lakh into equities or 30 lakh into equity. So very important to keep that in mind. It is just not plain. Even if you have a 10% equity allocation, you're not understanding that drawdown. Then even 10% become too difficult for you to hold in a difficult market condition.
Yeah.
So it is very, very important. And these things, data can be tested, but how people will react when they actually see portfolio losses, it is only when that moment happen, you'll get to know. That's why it's very important to have a good advisor working with you.
That's a fair point. Closing thoughts, if you're handing wealth over, what do you need to bear in mind? Because I know that a lot of people are quite enamored now because of the kind of wealth that has been created over the last 20 years, in particular in the equity markets, building intergenerational wealth. If you are somebody that is inheriting, how do you utilize that? Do you keep it invested? Because the tendency and the lure is always to utilize that and to improve your quality of living.
So हिंदी में कहते हैं कि धन के 3 ही रास्ते हैं, भोग, दान और नाश. Either you consume it or donate it or it'll get destroyed. The most worrying part is that when the wealth is being destroyed, it should not destroy our next generation. So it is very, very important. And in India, we keep saying that Lakshmi 3 generation के बाद टिकती नहीं है. Actually, it's not factually correct. We have seen in Japan 1500-year-old families, in USA 200-year-old family, in Europe 500-year-old family. The biggest challenge I see is not market volatility or what happened to a set category. The biggest challenge is I have seen many families don't have an investment policy or framework in place. It is one individual who will decide what is good for the family. It totally too much dependent on the skill of a single individual, and that individual may have a blind spot.
Key man risk.
So it is very important. It is very important. You should know that. Start involving your spouses, your kids in the decision making process. In the beginning, they won't understand anything. They'll be just plain listener. But it's very, very important. And I'll tell you why it is important. I'll give you just one simple illustration. Many people in India do give money to their relatives and friends. And generally, the person who's done well, people come to him for the money. And the money is given for 3 months, but, never comes back. So how do you control these kind of things? If it is in the hand of one individual and somebody approaches that individual, the money will be given.
Yes.
And we Indians are very emotional. We say, help karna chahiye, kaam nahi aayenge to kab kaam aayenge musibat ke time. That is money lost for good error. So what one should do is very simple thing. Frame an investment policy where your spouse and your kids are involved. So if your friend come, 3 of them will say no. If your spouse's friends come, 3 of you will say no. If your kid's friend will come, 3 of you will say no. So investment decision is not dependent on a individual skill, and investment is not a selection process, but elimination process. Just keep that in mind.
And on that very insightful note, Vijay, thanks so much for joining me on MoneyWise. It's been an absolute pleasure bringing you this program. Hopefully, it's insight that you can use. Do stay tuned. Lots more coming up over the course of the day. And this is NDTV Profit.